Hi, I'm Parag Dhol from Inventus Capital Partners. I have been in venture capital for a long while, last 7 odd years at Inventus Capital, and before that with various corporate VCs like Intel, GE, and ICICI Venture before that. Here at Inventus Capital, we invest in early stage technology focused companies. So essentially, most VCs, when evaluating a company, look for three key things. When I'm talking mostly about early stage investors, the first thing is always the team, the balance in the team, the chemistry in the team, complementarity in the skill sets, etc., etc., is the first criteria. Then the second one is the market that they are going after, the size of the market and how fast it is growing. The third criteria is the competitive differential that you bring to the table. It is our belief that a Me Too never really works or doesn't produce extraordinary returns for sure. So those would be the three criteria that we look for as well. So we tend to be slightly more conservative, given that we have been around for a longer while. India is honestly a difficult country to do business in, etc., etc. So we look for some beginnings, the semblance of a revenue model. Some of these companies in the US in particular, for example, which Snapchat is a great example, which don't have much of a revenue model, but they seem to have a lot of engagement. We don't see that scale of engagement in India, so it's not a view we have to take very often. That level of engagement without revenues is what we see rarely in India. So to that extent, we tend to be a bit revenue focused. That's a good way to judge engagement with customers. Finally, ultimately, if somebody pulls out a check and pays, that is the real test, isn't it? So with specific reference to, let us say, a Snapchat or a Quora, for that matter, see, these platforms have tremendous engagements, and Google in particular has proven that if you have tremendous engagement, then there is always a revenue model possible. Let's say WhatsApp, for example, just as an example. Most of us nowadays are hooked on to WhatsApp simply because all our college buddies or whatever, thanks to those groups. So even though WhatsApp doesn't charge me anything at this point in time, but would I mind paying $1, for example? The WhatsApp founder has a bit of a aversion to advertising as a business model, but he'll figure it out, I think. So I think it is dependent entirely on engagement. If there is engagement, I think there will be revenues. That's a bet that most people are willing to take. In India, unfortunately, there are very few companies, NewsHunt, etc., are probably examples, where the engagement is as high or anywhere close to this. NewsHunt is also a fraction of any of these numbers, but nevertheless, there is substantial amount of engagement, but we see very few of those models in India. So yes, some of these city-driven food delivery startups, I think when you talk about valuation, those numbers look really strange to me, honestly. Simply because these city-based models, replicating them across one to the other comes with its own set of challenges. India is a heterogeneous country, etc., etc. So transplanting these models from a very smooth functioning country like the United States and trying to do it in India and having the same set of valuation expectations and the same set of underlying metrics expectation, I think is I would think twice before I would do something like that, honestly. Okay. So with respect to the Just Dial IPO and the lack of IPOs thereof, I think it's a combination of circumstances. One thing is the market still about 9-12 months back were not supportive of IPOs. Even today, some of the IPOs are facing challenges, etc. So that is one factor. Second thing is the regulatory regime in India has been very profit focused, etc., etc. Today in the newspapers there is some talk about SEBI doing away with some of those rules. Otherwise, a company has to have 3 years track record of profits. People are typically focused on that, whereas some of the earlier stage companies are more focused on growing revenues and consequently might not have a 3-year track record of profitability, etc., etc. So the Indian markets have to become far more accommodative of some of these models. Just Dial was a very profitable model. Take a company like Make My Trip, for example. That couldn't possibly have gone public on the Indian markets. But it did go public in the international markets, isn't it? So I think all of us now in our portfolios have a few companies, maybe not in the 5s and 10s, but at least 1 or 2 companies which can possibly go for an IPO in the next 2 to 3 years. So I'm fairly positive about that. That being said, if you look at the history of venture capital, M&A in terms of frequency of exits will always outscore IPOs. IPOs are sexy, big, they hit the news, etc., but they are fewer. So yes, value add from a VC is kind of a nebulous concept. Many people talk about it, etc., but I think what it boils down to is situation specific help. I think the biggest help that an entrepreneur gets or a team of founders gets is that they get an independent opinion of somebody who's been in business for a while, who's looking at business plans on a daily basis, is getting a lot of signals from the market. So some of that signaling comes back to him or her as a team, the founding team, that is, as feedback. I think that is one of the key things. On a tactical level, yes, we help out recruit people, for example, for the firms, obviously help them raise their next round of financing, etc., even help them set up operations, etc., interview people, all of that, and any specific help that they need, an introduction to a customer, an introduction to a partner, strategic thinking, etc., it can take any of those forms. So yes, you in this business, you are a capitalist, you are managing somebody else's money, so you have to be clinical at times. If, for example, there is technology obsolescence, in which case we will have to take a view that, okay, the tap stops here. Tap stops at some point in time, or for that matter, the company is trying but is not able to achieve unit profitability because the business model itself was something that we tried, eventually did not work out. So in those circumstances, we lose faith in the team. Maybe somebody quits, or we took a wrong call on a guy, we don't like the guy for whatever reason, maybe he's too tactical, maybe he's too interfering, whatever those cases may be. Or in certain circumstances, it could also be structural. For example, we manage 10-year funds and we are in the 8th or 9th year of a fund, and this company is still a small company. At that point in time, you need to take a view that if somebody else is willing to come in and take the risk for the next 5 years, then I might be willing to get off, because the company is still 5 years away from an IPO, so to speak. So those are the circumstances under which one of us would want to bail out. So yes, there have been a lot of food tech entrepreneurs. Now it seems to be managed services kind of a marketplace, so plumbing, carpenters, etc. So we have seen a lot of IoT kind of startups recently doing things like wearing things on the nose, or for that matter on the ear, so that they can do fitness stuff, for example. So I think broadly, I am not one of those people who understand the marketplace who claim to understand the marketplace at such a level that I can suggest to you, do this or do that. I think that would be specious thinking on my part. I'd rather leave it to the underlying entrepreneur of the ground. But I would have just one request. Do not just plainly copy somebody else's model, especially what is called as concept arbitrage, because it succeeded in the US. That's why I want to do it here. Try and find a problem that you faced yourself and you think you can solve in a unique way. don't try living somebody else's life. I think Steve Jobs said that beautifully. So that characteristic, or that criteria, I should say, should apply to what you do. Only then can you have a chance of succeeding, because the world is pretty hard and competitive. So as far as risks of investing in a startup go, I think I'll go back to the three criteria that I talked about. Essentially, it is the team, whether they can make it. They have the chops between themselves to kind of recruit the right people under them, for example. Do they stick together? So team risk is obviously one of the key criteria that becomes. Does the market pan out as you planned it, for example, or does your product fall by the wayside because of technology obsolescence? Or maybe your technology just didn't work, or didn't get up to the mark, or somebody had far better features, or the UI was so much better. It could be any of those things in that second bucket. And in the third bucket, if you can't differentiate yourself, then you become an ordinary company. You might survive, but you'll definitely not lead to extraordinary returns. So finding that niche for yourself. There are multiple other risks. For example, cash itself is a risk, isn't it? Some of these high burn models, for example, you are riding a tiger. Taxi for Sure, for example. Unfortunately, sequence of events, if you read the Mint article today, for example, could just impact your business, because somebody else gets funded and an Uber incident happens in Delhi and your plan falls by the wayside. So there are multiple risks. So even in India, which supposedly is supposed to be safe investing, any investing is risky at any point in time. I think at the stage that we invest, maybe we don't invest in an idea stage, but nevertheless, many of the risks that I talked about remain. Honestly, I think that particular incident, I hope it is a one-off. It is something that maybe people got carried away or whatever, but this ecosystem, it's a fairly nascent ecosystem, and all our futures, I think the entrepreneurs, ours, and everybody connected with the ecosystem, all our futures are dependent on it. And it's not as if it's a faltu ecosystem, or it has no wind behind it. It is something that can prove to be a real value add to India. So I would honestly urge all sides to make sure that we don't hurt the ecosystem in any way. I don't think distance between any two participants of the ecosystem, VCs and entrepreneurs in this case, they going apart is good for the ecosystem. So I would look at it that way and say that contain the damage. One incident happened, okay, fine, it's a one-off, let's move on. It's not emblematic. I'm sure it's not emblematic of the entire ecosystem. Great time to be an entrepreneur in India. I think the basics are available. People are willing to work for startups. Very smart people at a very early age are willing to work for startups. Tools are cheap. People are willing to give it to you for free. Large companies like Intel or Microsoft, etc., are willing to give away tools for free, etc., etc. Open source is available, for example. So it takes very little to get started. The negative of I'm a fairly old guy, so in our days the stigma of attached to failure was very high. Today that is not the case also. So it is a good step to try and be an entrepreneur if you find a problem that you can solve, and we are seeing really good quality people come out and solve some real problems. Our country has a lot of problems. We are all depending on your ingenuity to kind of solve all of these problems. And we are looking forward to partner with some of you in that process.